You ever stare at a market chart and it just looks like a bunch of random squiggles? Like you're trying to read a language you've never seen before? Well, today we're going to decode it. We're diving into one of the most powerful and often misunderstood tools out there, the Elliott Wave Principle. Let's get into it. Okay, let's be real. For a lot of traders, just hearing the words Elliott Wave makes them think of these crazy complex charts, a million rules. It's intimidating, right? It feels like something that's just way too complicated to actually use. But what if that's not the whole picture? Because the secret here isn't some crazy advanced math. It really all boils down to one thing: learning how to count the market's natural rhythm. The whole idea is, if you can figure out which wave you're in right now, you have a pretty good idea of what's probably coming next. So let's start at square one. The entire theory is built on this really core idea that the market doesn't just move randomly. Nope, it actually moves in predictable, repeating patterns. And what drives those patterns? Well, human psychology. And the engine that makes this all work is something called a fractal. The easiest way to think about it is like the market's DNA. It's a pattern that repeats itself over and over and over again, on every single time frame. Doesn't matter if you're looking at a 1-minute chart or a yearly chart, the same basic patterns are there. This is what makes counting waves even possible. And every single one of these patterns is built from just two simple kinds of moves. First, you've got motive waves. These are the engine, the power moves that push the market in the main direction of the trend. And then, you've got corrective waves. These are the pauses, the breathers, the pullbacks that go against the main trend. And that brings us to the basic blueprint. This is it, the whole game. A complete market cycle is just a 5-wave motive sequence going with the trend, followed by a 3-wave corrective sequence going against it. This simple 5-3 structure, that's the cornerstone of everything we're talking about today. Now, before we even think about counting anything, we gotta know the rules of the game. And there are 3 of them. 3 core, non-negotiable, unbreakable rules that every single valid wave count has to follow. Think of these as your guardrails. All right, let's nail these down. Rule 1. Wave 2 can never retrace more than 100% of Wave 1. That means it can't go below where Wave 1 started. Simple. Rule 2. Wave 4 cannot overlap with the price territory of Wave 1. They have to stay in their own lanes. And Rule 3. Wave 3 can never ever be the shortest impulse wave. It's usually the longest, but it absolutely cannot be the shortest of Waves 1, 3, and 5. And I really can't stress this enough. These rules are absolute. They're your foundation. If your count breaks one of these rules, your count is just wrong, period. You don't get to bend the rules, you have to find a new count. Okay, with the rules locked in, let's walk through the actual story of a market trend. We'll start with that 5-wave impulse sequence. This is where the action happens. It all kicks off with Wave 1. So picture this. The market's been in a downtrend forever, and everyone is super bearish. When prices finally start to tick up, most people just roll their eyes. They call it a bear market rally and see it as the perfect chance to sell even more. Then comes Wave 2. Price pulls back, and all those sellers feel totally justified. They're thinking, see, I told you so, the downtrend is back. But here's the crucial part. It doesn't make a new low. And the smart money, the informed traders, they see that higher low and start thinking, something's different here, and they start buying. Now, Wave 2 is usually a really deep pullback. It often gives back a big chunk of Wave 1, hitting key mathematical ratios traders call Fibonacci levels. You'll hear that 61.8% level mentioned a lot. This deep retrace is what's called the shakeout for a reason. It's designed to get rid of anyone who isn't sure. And that shakeout sets the stage for Wave 3. This is the explosion. This is the heart of the move, and it's almost always the longest and most powerful wave. As soon as price breaks the top of Wave 1, all that doubt turns into conviction. The seller's stop losses start getting hit, which is like pouring rocket fuel on the fire, and the trend just takes off. So how far does it go? Well, a really common target for Wave 3 is for it to be 1.618 times the length of Wave 1. That's another one of those key Fibonacci numbers. It's why so many people call this the money wave. After a huge move like Wave 3, the market's got to catch its breath, and that's Wave 4. The early birds start taking profit, and the price action gets messy. It's choppy, it's sideways, and it's famous for trapping traders with breakouts that go nowhere. This wave is designed to frustrate you. And at last, we get Wave 5. This is the final push higher. By this point, the trend is obvious to everyone. Your cousin is calling you about it. It's the retail wave. But here's the telltale sign.
The momentum is usually way weaker than it was back in Wave 3. You'll often see a big warning sign called divergence, where price makes a new high, but the momentum indicators don't. It's a clue the trend is running out of gas.
So once that 5-wave show is over, the market switches gears. It's time for the correction. And this plays out in a classic 3-wave pattern we call ABC. The correction kicks off with Wave A. It's usually a sharp move down, but most people just see it as another dip to buy. Then you get Wave B, which is the ultimate bull trap. Price rallies back up, sucking in all the hopeful buyers who think the good times are back, but it usually fails to make a new high before it rolls over and dies.
And that leads to Wave C, the final leg down. As soon as price breaks below the bottom of Wave A, the mood shifts. Everyone realizes, oh, the trend has actually changed. Wave C is often the same length as Wave A, but it can also extend out to 1.27 or 1.61 times its length, finally ending the correction.
Whew! So that's the whole 5-3 cycle, from beginning to end. Now let's put it all together into a simple final checklist you can actually use when you're looking at a chart.
So beyond those 3 unbreakable rules, here's one more powerful guideline. It's called the Principle of Alternation. It just means that the 2 corrective waves, Wave 2 and Wave 4, are going to look different. If Wave 2 was a sharp, quick drop, you can probably expect Wave 4 to be a long, sideways, messy one, or vice versa. It's a great little trick for anticipating the personality of the next correction.
And that's our deep dive. You now have the blueprint, the non-negotiable rules, and some key guidelines to start decoding the market story on your own. So I'll leave you with this question. Pull up a chart. What wave do you think we're in right now?